What's going on, everybody? What's going on? What's going on? Back at it again. Back at it again with another episode. Okay. Appreciate everybody for joining. Appreciate everybody for tapping in. This is going to be another good episode. We had a green day in the market. Very, very green day in the market. That was kind of weird. The reasoning behind it may be a little bit confusing. It may not be, but it's a good thing that we did see some green and we did see some relief. All right. Good deal. Good deal. Bear with me here for 1 second. But let's not waste any more time. Welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Please make sure that you share this episode, okay? I would really, truly appreciate it. Make sure you hit that notification bell next to subscribe so you can be in the know every single time I drop an episode, okay? Disclaimer, I'm not a financial advisor, nor am I a fiduciary, okay? I am not an economist. I don't manage money professionally, so please do your own research before investing into any stocks. Now, in this episode, we're going to look at some prices of the S&P 500, and this is really going to be mostly some technical analysis of the S&P 500, but we're really just going to have a conversation, okay? We're really going to have a conversation about what's going on in the market. You know, we're in September. We're nearing the end of September. Last week of September, only 2 more trading days in September, and September is historically the worst month in the stock market. And so, you know, we want to kind of dissect what's been going on in the stock market, prices that we've seen, prices that we may see, and kind of see what's been going on in the market today. So let's go ahead and let's get started. Let me share my screen here with us so we can go ahead and get started. Now, the first thing I want us to look at here is going to be the fear and greed index. Okay, that's going to be the first thing I wanted to check out. And that's going to be, you know, the fear and the greed index. So, you know what? Let's go ahead and talk about how the market performed today. The Dow Jones gained 548.75 points, up 1.88%. The Dow Jones is below 30,000. Okay, and right now the Dow Jones is technically in a bear market right now. Okay, the S&P 500 gained 71.75 points, up 1.97%. It's a level of 3,700, so 3,719.04. The NASDAQ inched out of that 10,000, that 10,000 range when it was down 30%, which it may still be down 30%, but it gained 222.13 points, up 2.05%. And so I've talked a lot about the fear and greed index on my Instagram. And, you know, so let's just do a little recap. I've also posted it on some YouTube shorts, so make sure you're checking out my YouTube shorts. But we know the fear and greed index is simply a measure of the fear and greed in the market. Okay, when we're more greedy, okay, that means the stock market is likely higher, and we're probably higher on that greed index. When the market is bearish, you know, investor sentiment is probably pretty low. And so when investor sentiment is pretty low, that means we're probably over here on the fear side. And this is measured from 0 to 100. And when we look at this fear right here, the previous close that we had, which was yesterday, we had an extreme fear of 17. I believe yesterday, intraday, while the trading was going on, we were around 16. So right now, extreme fear puts us at 19. If you pay attention to what we had 1 year ago, we were in extreme fear a year ago, right? Which was 12, right? Which coincides directly with what I just said, with September ordinarily being the worst month in the stock market. Okay, historically. 1 week ago, okay, we were at 27, so we were in that fear. And 1 month ago, we were at neutral, we were at 55. And so the first thing that I really want to say to y'all is we're in extreme fear, okay? If you have not been building a position in the stock market, okay, remember, I'm not a financial advisor, okay? I'm not a financial advisor, but this is the time to start buying. Okay, like we can't wait. Okay, we cannot wait because the stock market has ran so much in 2020 and 2021 that we finally got some relief. We finally have an opportunity to build some good position and getting at some good prices. And so now is the time for us to start a position. I'm not saying that you put all of your money into the stock market right now, but what I'm saying is that right now we are at levels where you need to start putting money to work. And as we go lower, you can average down into it and build that position along the way. Now, we're in extreme fear right now, but the market was up just about 2%. And the reason why that was because stocks and bonds rallied after the Bank of England said that they're going to be buying the UK debt. Okay, now why is that important? Okay, US stocks and bonds rallied Wednesday after the Bank of England said it would buy UK government debt on whatever scale is necessary in an emergency intervention to halt a bond market crash. Okay, now this is very, very interesting because in my last episode, I talked about stocks and I talked about bonds and I talked about the bond market. And so stocks and bonds were up, right? The Dow Jones rose nearly 550 points, the best day for the Dow since mid-July. Apple was the only Dow stock to end the day lower, following more than 1%, following a report suggesting weaker than expected demand for the new iPhone 14. I don't know about all that. Now, the S&P 500 and the NASDAQ composite both climbed about 2%. And the Dow and the S&P rebounded from the near 2-year lows that they set on Tuesday and snapped 6-day losing streaks in the process. And the Dow is also no longer in bear market territory. So it was in bear market territory for the first couple of days in the week, but we're no longer there. Now, Wall Street took its cue from the news out of England. Okay, the Bank of England announced its bond buying plans after sweeping tax cuts announced last week by the government of new Prime Minister Liz Truss sparked a sell-off in the bond market. Now, that helped news push U.S. bond rates sharply lower. The yield on the benchmark 10-year U.S. Treasury bond, we talked about that last week, okay, briefly topped 4% Wednesday morning before pulling back to 3.7%. The earlier surge was the first time the yield moved above the 4% threshold since April 2010 and the highest level for the 10 years since October 2008. So the 10-year Treasury yield is important for consumers and businesses since it impacts how much interest banks charge for various types of loans, most notably mortgages. The dramatic spike has helped push the average rate for a 30-year mortgage above 6% for the first time since 2008. Yields for the 10-year have soared from just north of 1.5% at the end of 2021, a stunning surge in a relatively short amount of time. Now, bond yields rise when investors sell treasuries, and traders have had plenty of reasons to dump the 10-year lately. Worries about runaway inflation have caused the Federal Reserve to aggressively raise short-term interest rates. That has pushed up longer-term yields, okay? Economic turmoil in the UK and Europe have also caused the value of both the British pound and the euro to fall dramatically when compared to the US dollar. Dollar strength typically coincides with higher bond rates as well. This volatility is having an impact on stocks too. The Dow fell into a bear market, more than 20% below its all-time high on Tuesday. The S&P 500 and NASDAQ have plunged even further this year. And so here at the bottom, we say the CNN Business Fear and Greed Index is a measure of investor sentiment. It is indicating signs of extreme fear as investors grow more nervous about a recession. Now, the last few paragraphs are right in line with what I was talking about last week when we were talking about when stocks go down, what happens to bonds, and it kind of depends. It kind of depends on what's going on. Now, this is what I want us to understand, okay? The reason why the Treasury yields went down is because the government, the Bank of England, is exhibiting QE, right? Quantitative easing, right? And what they're doing is that they're buying up bonds, okay, to pretty much shore up the economy, pretty much to save the British pound and save the economy, which is the opposite of quantitative tightening. which would be selling bonds, raising interest rates, right? And so here in the United States, the 2-year note, the 10-year note, pretty much all bonds went down as well. Now, what I don't understand is that if the Bank of England said that they're going to be buying bonds, okay, they said that they're going to be buying bonds. Why is the U.S. 2-year note going down? Why is the U.S. 10-year note going down? And I'm thinking that it's because investors may feel that if the economy got to a situation, if we got into the bad recession that people are expecting, that the Federal Reserve will pivot. They will quote unquote pivot, and they will lower interest rates and buy bonds to shore up the economy. Now that remains to be seen. Why? Because the US dollar is very strong, right? Or this is one of the best years for the dollar in the last 20 years. Okay, so the dollar is not weak, okay, but the British pound and the euro is weak. So the Bank of England, they have to make the decisions to save their economy. We don't have the same problems over here. Why? Because the dollar is strong, okay? The economy over here has not faltered as of yet. The economy is still okay. The unemployment rate is still at, historically low rates. So the Federal Reserve is really truly in that position to where they're saying we want to continue to raise interest rates, okay? And the Fed has not said anything differently. And so what we really truly have to keep in mind is that, yes, we were up almost 2% on the S&P 500. However, that was because of news out of the Bank of England, okay? We still have to see what's going to be going on because we have some economic news that's going to affect us over here in America, that's going to affect whether or not the Federal Reserve is going to be making decisions on what they're going to be doing and what they're not going to be doing. With that being said, let's look at this United States economic calendar. Okay, now tomorrow, we're going to be getting real gross domestic product revision. So GDP, we're going to have the GDP revision from the previous quarter, Q2. Now, I want to see how the market is going to react to this. The market may not care. The market may not care what the GDP reading was from last quarter, but it's important to understand where we are. And we're going to have a lot of members of the Federal Reserve speaking. St. Louis Fed President James Bull is going to be speaking tomorrow. San Francisco Fed President Mary Daly is going to be speaking tomorrow. Okay. And also Nike, Nike is going to be reporting earnings after the bell on tomorrow. Nike stock has been getting a lot of revisions down due to the fears that they have been performing badly over in China because Nike has such a large business presence over in China. Okay, understand that if Nike gives us a really, really bad reading, as if they anticipate it to happen, that's not going to bode well for the Dow Jones because Nike is a Dow Jones component and Nike is also in the S&P 500. And so me personally, I like Nike a lot. I've talked about Nike a lot on the Trade for Yourself podcast, so I encourage everybody to go back to previous episodes. But I'm going to be paying attention, especially as an investor, to see what's going to be going on in the economy. Now, Friday, we've got Pce Price Index, right? Another inflation reading, right? Pce, what's Pce stand for? It stands for Personal Consumption Expenditures, right? And this is the measure of inflation that the Federal Reserve says that they watch the most, right? This is the one that they say that they watch the most, okay, in terms of deciding what's going on with inflation. On top of that, we're going to see Friday morning, the market is going to react to Nike's earnings, right? We've also got Richmond Fed President Tom Barkin is going to be speaking. The Federal Reserve Vice Chairman, Lael Brainerd, she's going to be speaking. We're going to get the University of Michigan Consumer Sentiment Index, okay? We're going to see how people are feeling. Fed Governor Michelle Bowman, she's going to be speaking. Richmond Fed President is going to be speaking again. New York Fed President John Williams is going to be speaking again. All right, so we've got a lot of Feds speaking. So we understand what the Bank of England did, but this is going to be an opportunity for the Federal Reserve to potentially say, hey, we understand what's going on over there in England, but at the same time, the Fed may say, look, we're not pivoting. Okay, we're not pivoting. We're staying on course. We're staying what we need to do. And so I don't want everybody to just say, hey, the S&P was up 2%, we were down bad. It's time for us. It's time for us to, get back bullish, because at the same time, if you take into consideration, when we go to these charts and we look at some of these technical indicators and some of these technical studies, it kind of makes sense from a technical perspective anyway, why we even came up the way that we did. And so now, since we got that out the way, the remainder of the episode is really going to be looking at technical analysis. And so let's go ahead and pull up the technical analysis so we can really truly see what's going on. Okay, from a technical analysis perspective. And so the only stock we're going to look at is going to be SPY. Okay, SPY is an ETF that tracks the S&P 500. It's the most actively traded stock on the stock market, okay? And I have some levels out here drawn out. And so the first thing I want to do is that I want to pull up the weekly chart, okay? I want to pull up the weekly chart of the S&P 500, okay? And I want to see, where have we been, okay? Where has the S&P 500 been on a weekly basis? And so when we look at this, we have some levels, right? And so we know that we're in a bear market. We know that we have we know that we are in a defined downtrend, right? A defined downtrend is a series of lower highs and lower lows. And we reached the 52-week low this week. So pretty much we retested the low of where we were back in June, and we broke it briefly. We broke down briefly, and now we're slightly above the 52-week low that we set. But what I have right now here is that I have some levels drawn out for the S&P 500, okay? I have some levels drawn out, and these are the levels that I see that are potential levels that we could see the S&P 500 begin to touch. We had the 52-week low of 360.87, okay? So we made a new low this week. If we break that low and we make another low, I'm looking at the level, I'm looking at 50% retracement, okay? What is the 50% retracement? Where did that come from? The 50% retracement came from the Fibonacci retracement levels. And so we talked about Fibonacci retracements before. And remember, we draw Fibonacci retracements from an all-time high down to a major low. So we had the major low down here at the onset of the pandemic. That was when the market crashed over 37-40%. And so the 50% retracement from there would mark us right around 349.12. Okay. I think if we break below 360.87, it's a possibility that we can continue to come down to that 50% Fibonacci retracement. Okay. From there, another level I want to watch from below that would be the pre-COVID all-time high. Okay, why is the pre-COVID all-time high important? Is because when we're looking at technical analysis, we have to remember support and we have to remember resistance. Okay, so support is a level that we do not break down below. A support level is a level that the stock does not break below. Resistance is a level that the stock does not break above. But this is the thing I want us to understand, is that resistance can turn into support and vice versa. And so if we look a little bit closer to where the market was back in February of 2020, we were operating at an all-time high, and then we dropped down, and then we had the fastest pretty much increase that we've had of all time. So we had that big drop, and so that could be a marker. So pretty much since that was a previous high, since the market is in that downtrend, that could be an area to where we may see bulls buy in. We may see people want to buy in if we come down to that level. Okay. If we break down below that level, I have a second to last level marked at major support 30% from the high. Okay, why do I see this as a major support? Because I see multiple touches. Okay, I see multiple touches at this 319.80. Okay, let's see, January of 2020, we came down to around 320, which is close enough. Okay, in July 2020, we were around this area. We had some touches, 319 in this area. July 2020, we had touches. In September of 2020, we came down to 319.80. In October of 2020, we almost came down to 319.80. And so if we look a little bit closer in Q3 and Q4 of 2020, okay, this is a double bottom pattern that has appeared. This is a double bottom pattern that has appeared, which is a bullish pattern. And when you have that double bottom, that's showing me that we're getting even more support. And so I'm saying with us being 30% from the high and the fact that we're in a bear market, this is a level that I am watching that we may actually hit. Okay. If we continue to come down, if we continue to bleed down, that's a level that I am continuing to watch. So I want us to watch that level. And then let's go back to Fibonacci retracements one more time. Fibonacci retracements, what does that line up with the levels that I had? The 38.2% Fibonacci retracement level of 318.24 is right in line with that 30% below the high. So when I see that, I'm like, okay, these levels that I have actually do mean something. And then one last level that I have is the worst case scenario, right? That's if the economy goes horrible. That's if the Fed keeps raising interest rates. That's if the economy, unemployment goes crazy. I have a worst case scenario, which is 40% from the high at 287.98. Now, this is just worst case scenario. Me personally, I don't think we're coming down 40% from the high, but I have it on here just as a possibility. Look, if we come down 40% from the high, you have to buy. Like we're going to be in extreme panic, extreme fear. Everybody's going to give you every single reason not to buy because the economy has to be bad if we're down here. But if we're down here at this level, we have to buy. 287.98 is pretty close to the Fibonacci level of 280.03. It's not too far. 23.6% Fibonacci retracement. And as a rule of thumb, they say, you know, if we come below 23.6% on the Fibonacci retracement, rule of thumb is to say, hey, you might not want to touch it for a while based on from a technical perspective. And so what I'm looking at is I'm looking at these levels. And when I see these levels, I say these are levels that we need to start buying at. We need to start buying where we are right now. Okay, so let's look at where the market has been over the last 3 months. And let's look at some things and look at some potential levels. So, like I said before, we had the 52-week low earlier in the week. If we break below that, I'm looking at 50% retracement as an area. That's another area I would buy. So I'm buying at the 52-week low. If we came down to the 50% retracement, I'm buying there. If we came down to the pre-COVID all-time high, you see what I'm saying? I'm continuing to buy on the way down because I'm continuing to get better prices and I'm continuing to build a position because I'm telling you, I'm not buying 100 shares at a time. I'm not even buying 10 shares at a time. I'm only buying 1 to 2 shares at a time because I'm building a position in. I'm being slow with it. I'm building and I'm building and I'm building. And I'm going to build that position and be happy once the position has been built. And so I'm looking at this on a weekly chart. Let's break it down to a daily chart really quickly here. And let's show ourselves something, okay? Because I want us to take a look at this RSI. Okay. I want us to look at this RSI level. Now, remember earlier I was talking about that the S&P 500 was up about 2% today. Okay, and it was up about 2% because of what was going on in the Bank of England. But from a technical perspective, it kind of makes sense why we had a bottom. It kind of makes sense why we had some relief today, especially if you're a cynical person. It kind of makes sense that we had that. Why? Because if we look here at the bottom, let's look at this RSI. Now, what is the RSI? The RSI is the relative strength index. Okay, the relative strength index measures overbought and oversold conditions of stocks. Okay, if the RSI is above 70, that means stocks are overbought and we are running hot. If the RSI is below 30, that means stocks are oversold and we are running cold. You see this RSI level was at 26. We were at 26.9 on the RSI level below 30. When we get below 30 on the RSI, it's only a matter of time before we have some relief. And today happened to be the day that we had that relief because of that news that happened. Understand this, that there's a lot of algorithmic trading that goes on in the market. And so when certain news comes out, institutions already have levels and they already have algorithms set to start buying stocks and to start buying certain positions. And so this gave us, you know what I'm saying, that opportunity to continue to buy. Understand this, bonds have been performing very badly, but today the yields came down, which is a good sign. When yields come down, that means that investors are putting money to work. They are putting money into bonds. Pretty much they're buying up. They're buying up the treasury yields. They're buying up the treasury notes. What that is saying is that investors for today had faith in the United States economy. Pretty much they had faith that the United States was going to pay them back, and they feel as if the Federal Reserve is going to do some changing if the economy does go bad. Now, I don't know what the Fed is going to do. I don't know if they're going to raise another 75 in November. That's a possibility. Are they going to raise another 75 in December? That's a possibility. A lot of people say that may be too much. Some people say it's maybe too little. That's neither here nor there. What we need to understand is that understanding bonds and understanding the relationship between stocks and bonds is very important. That's why I felt that having that intermediate episode last week was very, very good when I was talking about bonds. So I really suggest everybody to go back and look at that episode. Now we understand from a big picture. We understand we're in a bear market. We understand the price targets. We understand where we're trying to get in and get out of and levels that we're watching in best case and worst case scenarios. Let's look at what has been going on over the last week. Okay, what's been going on over the last week? And that's important for us to see, because before we had this good news today come out, we were fighting to get above 370. Okay, we were fighting hard to get above 370. And what I'm going to do is that I'm going to mark a resistance level to show you all where we were and why it was so hard for us to get above that 370. Now, I've got a red line marked here. I'm gonna go ahead and put it where it needs to be. And I want us to, and I want you to understand that this was resistance for a period of time. The market had a hard time getting past this level. Okay. And we're going to talk about this in depth. Okay. We're going to talk about this in depth and talk about how the resistance has been going on over this week and how we've been trading. If you look at where we were in Monday, first of all, let's explain what we're looking at. This is a 30-minute chart. Okay, this is a 30-minute chart. And this 30-minute chart is explaining to us pretty much what this 30-minute chart is showing us is that every single candle that we see represents 30 minutes of price action. Okay, represents 30 minutes of price action. And the gray area is pre-market action. That's overnight and in the morning. The black area is actually intraday trading, when the stock market is actually open and we see trading going on. Now, on Monday, we hit 370 and we came down. Okay, had a 52-week low. In the pre-market, we came up. We came to resistance of 370.41, couldn't break above 370, came down, hit another 52-week low. So yesterday we had another 52-week low. And then we had some relief in the pre-market, okay, in this gray area, we had some relief. But what happened was overnight, we got some bad news and the futures came down. So the bad news was Apple, right? Pretty much there was an article that came out, an anonymous source reportedly said that the Apple was going to halt additional production of the iPhone 14 because of the lack of demand. And so what happened was the market was bleeding down off of that. Apple is the stock that has held up the most, right? Most stocks are down about 30%, right? Microsoft, Tesla, Google, Amazon, NVIDIA is down 50, AMD is probably down 50. Most stocks are down pretty bad, but Apple was the only one that was able to hold up enough. But with that bad news, that was pretty much insinuating that was the straw that broke the camel's back. And so if you look at this low, we had a low of 358.72. That was in the pre-market though. That was when the market wasn't open. That was with the pre-market. And right around 5 o'clock in the morning, we got the news that the Bank of England was going to be buying bonds. Okay, they were going to be buying treasuries, right? They were going to be buying treasuries, and everybody thought, okay, since the Bank of England is going to be buying treasuries, it's a possibility that the Federal Reserve may be buying treasuries. And so what happened was we had that relief. And so Apple was down about 4.5%, but they closed only down 1.5%. And so that news didn't really mean anything, to be honest. And the Bank of England pretty much saying that they're going to have faith in the economy was really what was most important. And so intraday, we saw us break above that 370 level, and we came all the way up to 372, came back down, and we closed around 370, 371 and some change. Okay, that's where we closed. We closed around 370.48. And so pretty much we still closed at that 370 level. So, we're still at that, we're still technically kind of at a resistance level, but at the same time, this is the first time that we were able to break above 370 and get to 371 on the week. But understand this, first thing I want to tell you is RSI was already below 30. And since the RSI was already below 30, we were due for relief. Volatility index was above 30, right? So you're gonna have big jumps like that when the RSI is below 30 and the volatility index is above 32. We're gonna have those bear market situations. But the thing is, though, is that we have so much more economic data to look at and to evaluate. We have to listen to the Federal Reserve speak. We have to listen to what Nike said on their earnings call. We have to listen to PCE inflation, job numbers, unemployment numbers, more CPI readings next month and earnings coming next month. So what I'm saying is that I'm not telling us not to buy anything, because I'm of the camp that we need to be long-term oriented anyway, and we need to be rooted in the long-term anyway. So we should be buying and building positions along the road. But I don't want us to have a misconception based on what happened just today. Let's see what happens the next 2 trading days. Let's see what happens over the next 7 trading days. Let's see what happens over the next 30 trading days, right? Because we're going to have a lot of information coming out that's going to give us a consensus about how the market really truly feels. And so before we get out of here, I'm going to go back to the daily chart. Okay, I'm going to go back to the daily chart. Let's bring this in a little closer for us. Okay, let's bring it a little closer for us. Let me remove this resistance level since we are back on the bigger time frame. We're back on a bigger time frame now, so we're not looking for an entry, right? Remember this, the bigger time frames let you know the direction, the smaller time frames give you the entry. And so we're not really looking for an entry anymore. But what I want to do is I want to get a little bit closer, and I want to bring up a volume subgraph. Okay, I want to bring up a volume subgraph, and I want to see how has the volume been. Okay, how has the volume been pretty much over the last 3 months? And over the last 3 months, we've been in summer. We're pretty much getting out of the summer now. So what I want to see is I want to see what has the volume been like. Okay, and the volume has been pretty high. The volume has been pretty high, and now the volume has came back. Now, if you look at pretty much from the end of June, pretty much through the beginning of September, the amount of volume, we were like 30 million, 40 million, 50, 60, 80 million at sometimes. The volume was relatively low. Now in September, when everybody's coming back off of vacation, which happens historically on Wall Street, volume increases, and we get to see how the market really truly feels about what's going on. Because on August 26th, we had 103 million shares traded. September 2nd, 99 million traded. September 13th, 122 million shares traded, 103 million shares traded, 122, 108 yesterday, 110 today. So now we've got a whole lot of volume in the market. And so now we're kind of getting a consensus of how everybody truly feels about the market. And so I really wanted to come on here, do some technical analysis, look at some things, and let's look. I really want to just come on here, look at some technical analysis of the S&P 500, and really just have some conversation about what's going on in the market. Okay, it's really all I really wanted to do. And so, again, as always, I appreciate y'all for tapping in to another episode of the Trade for Yourself podcast. Okay, remember, y'all, please like. Okay, please like the video. Please like. Please subscribe. Okay, because this is important for me to get higher in the algorithm, for me to get higher in the algorithm, and for me to get this information out to more people so we can continue to build and continue to make building wealth a priority for our lives. Remember to subscribe. Remember to always reach out to me in the comments, okay, and let me know what you want to know about the S&P 500. Let me know how I can help you, because at the end of the day, I really truly want to help you succeed and really give you the information that you need to be successful. Remember, we're in extreme fear right now, but this is exactly where we need to be. We need to be in extreme fear. So now we can get the prices, like we can get these great prices so we can build a position and really truly build that wealth that we need to build for ourselves. All right. Thank y'all for tapping in again. I'm going to see y'all later. Remember, don't pay for it. Okay. Trade for it. I'm going to catch up with y'all later.